Depreciation methods. 4 types with formulas and examples. Let's start.
Depreciation is an accounting method that considers an item's initial cost or value, what it may be worth at the end of its life, and how its value changes over time. Instead of writing off an asset that devalues the asset, depreciation recognizes the asset's usefulness over time and how the asset changes with use. Learning about common depreciation methods can help you determine an asset's value. In this article, we explain what depreciation is, share 4 depreciation methods you can use, provide example calculations, and answer frequently asked questions about depreciation. Key takeaways. Depreciation accounts for decreases in an asset's value over time. The 4 methods for calculating depreciation include straight line, declining balance, units of production, and sum of years digits, SYD. The best depreciation method for a company to use depends on its accounting needs, types of assets, size, and industry. What is depreciation? Depreciation is a business concept that accounts for a tangible asset's drop in value over time from the frequency of use or obsolescence. There are 4 ways of calculating depreciation following generally accepted accounting principles, GAAP. It's important to consider the asset and its use when choosing a depreciation method because the method used affects the book value and revenue. It also addresses different circumstances to calculate depreciation favorably. Because most companies use a single depreciation methodology for all of their assets, the use of various depreciation methods is typically industry-specific. When a company picks a depreciation method, it must use it for that particular asset. Changing it would require a revision of previously submitted. 4 depreciation methods to consider. Here are 4 common methods used to calculate annual depreciation expense depending on the asset. 1. Straight-line depreciation. The straight-line method calculates an average decline in value over a period. This is the most common method and the simplest way to calculate depreciation. In straight-line depreciation, the expense amount is the same every year over the useful life of the asset. You can use the straight-line method on assets such as vehicles, office furniture, equipment, and buildings. A variation of the straight-line calculation is the fractional period depreciation. Assets acquired in the middle of the year use the fractional period depreciation application. In this case, the partial period calculation uses a fraction of the straight-line method to value the asset. Straight-line depreciation formula. The straight-line method provides the same deduction amount every year until the asset reaches the salvage value or full depreciation. Here's the formula for straight-line depreciation. Straight-line depreciation equals cost minus salvage value of the asset / useful life. Tip: the straight-line method is often best for small businesses that need a simple depreciation method. This is the simplest and most commonly used way to calculate depreciation and is used when an asset's value declines evenly over time, such as a piece of machinery that you expect to use until it stops working. 2. Declining balance and double declining balance depreciation. The declining balance method assumes an asset is valuable in its earlier years and loses value in the coming years. It declines over time until it reaches its salvage value or full depreciation. New companies or those expecting less revenue in their first years may choose this method to lower tax bills by claiming larger depreciation expenses. This method is also known as the diminishing balance method, reducing balance method, or written down value method. Some companies may use the double declining balance method, which applies a more accelerated depreciation. The declining balance method is often used to determine depreciation for computers, mobile phones, and other technology products that quickly become obsolete. Declining balance and double declining balance depreciation formulas. The declining balance method provides much larger deductions in an asset's earlier years and deductions in its later years. Here's the formula for declining balance depreciation. Declining balance depreciation equals beginning book value x rate of depreciation. Here's the formula for double declining balance depreciation. Double declining balance depreciation equals 2x beginning book value x rate of depreciation. Tip: the declining balance method is often best for organizations with assets that initially lose greater value, such as a new vehicle, and that want larger depreciation deductions sooner. Three units of production depreciation. The units of production depreciation method calculates an equal expense rate to each unit produced. This type of depreciation method is most useful when an asset's value lies in the number of units it produces or in how much it's used, rather than in its lifespan. The higher the production, the more the expenses. The units of production depreciation method accounts for those conditions. Units of production depreciation formula. This method produces depreciation amounts that vary annually depending on the number of units made per year or accounting period. Here's the formula for calculating units of production depreciation. Units of production depreciation equals original value salvage value / estimated units produced over assets lifetime x actual units made per accounting period. Tip: the units of production method is often best for production-focused businesses with assets that decrease in value as they produce more units. Four, sum of years digits (SYD) depreciation. The sum of years determines depreciation at a rate faster than the straight-line method but less than the declining balance method. It yields higher depreciation expenses in the early years and declines later. It's useful when an asset loses most of its value toward the beginning of its useful life. SYD depreciation formula. To calculate the sum of years, divide the remaining life of an asset by the sum of the years of its expected useful life. Then multiply by the depreciation base to determine the expense. Here's the formula. SYD depreciation equals remaining lifespan / SYD x cost minus salvage value. Tip: the SYD method is best for companies with assets that will lose more value in the early years and that want to capture write-offs that are more evenly distributed than those determined with the declining balance method. Straight-line depreciation example. A company buys a truck for $20,000 and estimates to use it for 5 years with no salvage value. To calculate straight-line depreciation, the company divides the asset's cost by its estimated life. Straight-line depreciation equals cost minus salvage value of the asset / useful life. Straight-line depreciation equals $20,000 to $0 / 5 equals $4,000. Using this method, the company finds that the first year's depreciation is $4,000 and lowers the asset's value to $16,000 at the start of the next year. This continues yearly, applying $4,000 to lower the book value to $12,000. This continues until the asset reaches full depreciation in the 5th year.